to the next installment of Diversified's Asset Class and Manager Spotlight. My name is Mike Horwath. I am the Chief Investment Officer at Diversified Lifelong Advisors, and today we're going to go through taxable fixed income. Most people know taxable fixed income or taxable bonds as really the main tenets of your bond portfolio. The bond market encompasses a much bigger portion of the market than stocks do. Even though stocks get much more of the notoriety and much more of the conversation, the bond market is substantially larger than the stock market is. So what makes up taxable bonds? Really, you look at it in a few different silos, right? You think about it from your normal government bond portfolio, so U.S. Treasuries, mortgage-backed securities, to corporate bonds, both investment grade and high-yield corporate bonds. Think of it also internationally, so international sovereign bonds, so the bonds of the country of Germany, Japan, France, also within emerging markets, so China, Brazil, Russia, India, and within those same countries, the corporations issuing the same type of debt as the government of each country would be. So what are the characteristics of bonds? It's important to start with the difference between stocks and bonds. Right, so stocks are equity ownership of a company. Bonds are the debt of a company or a government or some sort of entity. So think of it this way. I give money to the U.S. federal government, so say $100,000, and they pay me periodic interest, which is called a coupon. And at the end of the term, or when it comes to maturity, they pay me my principal back. So I give them $100,000, they pay me a certain interest rate periodically, and then at the end of the term, they give me my principal back. So this is a big use of global markets where corporations and governments have access to capital by issuing debt. And depending on the credit rating or the credit worthiness of the corporation or the same government, they're going to pay different interest rates. So they provide stable income. They also, as you're going to hear in a moment, provide a diversification benefit to their investors. So really the main characteristics, though, are these are debt instruments rather than ownership instruments. They pay periodic interest, and at the end of the term, you're going to get typically your principal back. So why do we use them in a portfolio? Most people know bonds as their stable portion of their portfolio. So bonds are inherently more stable because they're less risky than stocks. It's important to know that if a company goes into bankruptcy, the debt owners are higher up in the capital scale than equity owners. So people would get their bond money back quicker than they would get back their equity ownership of a company. So stocks carry more risk. Over time will generate higher returns. But obviously, it comes with that trade-off in the end. So they provide stable income for investors. They provide stability. They provide that diversification benefit. So historically, when stocks have fallen, right, when there's a recession or when there's stock market corrections, bear markets, when there's volatility, bonds perform pretty well. The reason is typically supply and demand. Most investors are looking for a more stable portion of the market. They flock towards the stable portion of the bond market, typically government bonds, and that performs pretty well. So think of it in the context of March 2020, when markets pulled back over 30% in the course of about a month. Bond markets appreciated, provided diversification benefits at that time. It's important, though, when we think of it as part of our portfolio and stability portion of our portfolio, that we look at it from a credit rating standpoint, from a credit quality standpoint, from how much risk we're going to take. Because even though corporate bonds will add more return theoretically over time than a government bond because they carry more risk, just that point alone, that they carry more risk, needs to be taken into the context of what our bond portfolio looks like. But in the end, they provide stability, they provide income, and that diversification away from stock market risk. So historically, how have they performed? It varies year to year. It depends what happens within the stock market or within the economic backdrop. It also depends what happens with interest rates. But in the end, you typically would expect low, mid-single-digit returns from your bond portfolio. As you'll see on the screen, Historically, the higher risk areas of fixed income, high yield and emerging market debt, have provided higher returns over time, but they carry more risk. The Barclays U.S. Bond Index is a great proxy for the bond market. It encompasses most investment grade U.S. bonds. And you can see that it's actually had a very good year. While we think of stocks having a good year so far in 2020, it being December at this point, also remember that the stock market went through some turbulent times back in February and March, and the bond market provided a very, very beneficial diversification benefit at that time. So while bond portfolios, they do provide low, mid-single digit returns over time, or at least have historically, more importantly, they provide that diversification benefit during times of equity market stress. So how do we think about the bond market at this point and moving forward? I think it's important to start with what we know. We know that the Federal Reserve is going to keep short-term interest rates low. And that's what this chart demonstrates, that you can see on the screen at this point, that the Fed expects that interest rates are going to remain at pretty much a zero level for at least another year or two, or maybe even 3 years, until the economy really picks back up. We also have seen that U.S. government bond yields that were yielding in the 2-3% range not too long ago are now yielding in the under 1%, so in that 60 to 80 basis point range, so 0.6 to 0.8% range. You're not getting a ton of yield on a government bond at this point. So we're looking outside our government bonds to drive some additional yield, to bring in some diversification, to give us a little bit of growth. But we have to be very careful because, as I said earlier, corporate bonds, high yield or investment grade, emerging market debt, these carry more risk than a government security would. So we like active management. We like having professionals managing this portion of our portfolio. We also like the ability to diversify it out. We like the ability that over time we can add value above a government bond of returns, but we need to do it in a risk-conscious way. So really, in summary, we look at bonds for the stability portion of our portfolio. Remember, bonds are debt, stocks are ownership or equity in a company. Bonds will provide more stability. They come with a lower expected return because they carry less risk, but they provide a very important diversification function within our portfolio. It is proven here in 2020. It's proven historically over time. You just have to be patient, and you have to understand the context of why we own bonds in our portfolio. And really what our outlook is we're constructive on the U.S. economy, especially as we come out of this COVID situation, as the vaccine creates a herd immunity over time. And we're looking for the diversification of things outside of government bonds, right? So the corporate bonds, whether it be investment grade or high yield, mortgage-backed securities, and even emerging market debt to enhance our return profile within our bond portfolio. So I hope you found this valuable. As you can tell, the bond market is quite large. It can be quite complex, and there's various types of bonds and various sub-asset classes of bonds. But it's very important to know what position they play in your portfolio. And I hope you found this valuable. So until January, when we get back together and we talk about the year that 2020 was, the quarterly investment review, and we'll do an annual investment review at that time. My name is Mike Corwant. I'm the Chief Investment Officer here at Diversified Lifelong Advisors. Happy holidays, Happy New Year. We'll reconvene in January. And until then, stay safe, stay healthy, stay wealthy, stay happy, and we'll talk soon. Take care.